Do we finally have evidence that the stock market is a reflection of the economy, but maybe not in the way most people think? What we're taught to believe is that the stock market prices fundamentals, when maybe the stock market prices more than fundamentals. On Friday, famous internet investor Roaring Kitty held a live stream on YouTube, which attracted an astronomical amount of attention and views. And it was basically a circus, which raises a whole bunch of questions that have nothing to do with either Roaring Kitty or GameStop. And like I said in the introduction here, maybe the stock market is a reflection of the economy, but in the other direction. In other words, people are attracted to this because they realize it might be the only path to the American dream. Has the American dream shifted from working hard, getting a good job, buying a house, and doing all of that to there's really no jobs out there, and those that are available are not going to pay me all that much. So rather than a life of living in my parents' basement, I'm going to go gamble at the casino. I'm going to go gamble at the legal casino, the biggest casino on the planet. Why not buy some GameStop shares? And it just got to be an absolute circus, which I think is representative of the underlying fundamentals in the economy. In fact, it got to be so bad. Here's what one article wrote about it. Shares of video game retailer and meme stock sensation GameStop plunged Friday afternoon and were throttled multiple times as the investor responsible for the craze behind them held a live stream. GameStop shares were down more than 33% shortly after 12:45 p.m. Eastern, 45 minutes after Keith Gill, who's the investor known as Roaring Kitty, began a highly anticipated live presentation on YouTube. The New York Stock Exchange halted the purchase and sale of GameStop shares more than a dozen different times throughout Friday as they plunged in value. I mean, what an absolute circus. But again, I think it's appropriate and representative of the way things are going in the 2020s. So Steve, Mr. Van Meter, let me ask you the question about GameStop. Not necessarily about GameStop, but just the entire episode and the whole vibe behind it. It seems, again, more like a casino than something you would associate with financial services and investing and all of that kind of stuff.
Yeah, absolutely, Jeff. And you start to think about like why is the stock market turning into a casino? Because you have someone like Keith Gill, Roaring Kitty. This guy, made an average salary doing financial services and estimated net worth in the tens of millions of dollars because he talked about a stock, and then a bunch of things started going right. And next thing you know, the whole thing exploded and he got rich. And that's becoming the new American dream is you can't win the lottery. You can't get ahead in the economy. So you might as well YOLO the stock market, because if you're young and you risk it all, well, you're going to work forever anyways. That's kind of what people are thinking. So why not take the risk? The problem is, you and I know, is if you get wiped out in your early life on the markets, well, it means you've got to save even more over the long term. What it's going to do is start to create people gambling more and more just in the hopes that they win big. And this is just a function of the economy. I think if people were actually getting ahead like they're supposed to, and as we've seen in generations of the past, you wouldn't see this mania and this hope that they could somehow make big wins on things like GameStop, which if you actually look at the earnings and revenue of this company, is terrible, but yet people want to buy it.
Yeah, I mean, we've always had bubbles in the past. You can think back to the dot-com period, for example. People were gambling on dot-com stocks. It just seems like it's, and I don't think it just seems like, it actually is far more pervasive this time. I mean, there's any number of options. Let's not just the stock market, cryptocurrencies, meme stock or meme coins and things like that. I mean, there seems like everywhere you turn, there's an outlet for you to gamble in some sort of financial fashion, where you don't just actually have to go down to a casino and play some game like blackjack. You can actually have it's right on your phone. It's easy, convenient, and everybody is attracted to it because, I mean, yes, there's this human nature part of it where we're all attracted to gambling in some fashion. Most people tend to be more prudent, but I think that's what we're really saying here is that most people's their default setting is to be prudent, to stay away from that. But if you're realizing that the real economy and the way that most people had gone about their business in years past, that path isn't available for you, at least not in the same way it used to be. Even though, your first inclination is to stay away from something like GameStop, maybe you think, well, what's the harm here? The downside is, I lose some money, but I'm stuck here anyway. I don't have an upside in the real economy, so why not create some upside gambling on Dogecoin or something else that comes along the way?
And we talk about GameStop here because this is really interesting. I did indeed tune into the live stream because I was very curious here, because there's something I find very interesting is that the CEO is issuing stock here. And this is really odd because right now, what are we hearing about the market? It's corporate share buybacks. They're the biggest buyer stocks. $5.5 million worth of shares a day, or dollar amount being bought every day, money coming into the market, just big numbers. And this is something that's critical. And when you think about what should be happening here, if there's demand for your product, in the case of shares, you should be selling them. And that's what I love about what GameStop is doing here. They finally woke up and realized, hey, you want to buy the stock of this company? Well, look at the earnings. We're not making money. Nobody wants to come to our stores, but you want to buy our stock? We're going to sell you all the shares we can. And if I was a CEO, I'll tell you, Jeff, what I would do. I'd be paying off all of my debt, and then I'd be amassing all the money people are willing to give me, and I'd probably go out and buy 2 or 3 other companies and come up with a whole entirely new business model and take this cash and do something good. And we think about, when this market eventually turns, when the casino eventually goes, because we know the house always wins. You're going to see during the next downturn is people are going to be running for the hills. And what are these companies going to be? Well, we don't have any money to buy our stock back because, revenues are down, and we have a ton of debt. And the market does this backwards. They should be selling stock now, paying off their debt. And if you want to buy your stock back, do it when it's cheap. Now it's at all-time highs.
That's the fundamental argument for the stock market to begin with, right? Not only is it a discounting mechanism, or supposed to be a discounting mechanism for information in the real economy, it's supposed to be a way to distribute funds in a productive fashion. Small companies that need financing to become big companies, that you go to the stock market, race, sell some shares. But over the last 15 years, it's been, just as you said, Steve, the exact opposite. Companies look at the real economy and say, I don't want to invest in this stuff. There's no opportunity here. I'm just going to buy back my own shares because that makes more sense. And it just feeds into this mentality as well as the results. It becomes this self-fulfilling prophecy, because share prices go up and it attracts more people into the casino. And as more people come into the casino, share prices go up and more people come in. It just becomes this unproductive doom loop where the real economy never gets the attention it deserves from the corporate sector or anyone else. No productive investments, or not nearly enough productive investments that would put people to work and give them high-paying jobs and opportunities. Instead, it just all goes in this direction of hyper-financialization, sort of by default. And you're right. We need companies who are selling shares and doing something with the proceeds, rather than taking proceeds from the real economy and giving them back to the stock market. That just goes round and round and round at the circus casino.
Well, yeah, Jeff, and the worst part is Wall Street encourages these companies to borrow money to buy their shares back. They say, look, you not only do you have cash, but you have great credit. So keep buying your shares back and do more of it. And that's exactly what's going to happen during the downturn. We're going to see all these companies say, oh, we're burdened under this heavy debt load. Well, why do you have it? Oh, you were buying your stock back instead of using the debt for productive purposes. And again, you just kind of mentioned that the economy could be doing possibly a whole lot better if we were seeing productive uses of money, but we're seeing these highly unproductive uses. And it just kind of makes you wonder that when the casino eventually closes, it's going to happen. There's going to be a day where we have a real bear market and the house is going to win. It always does. There's going to be a lot of lives really financially ruined by this, not from just retirees, but from young people who believe that stocks never go down. They look back and say it can't happen again, but you and I know that day will eventually come.
Oh, you just said something here. You said if the economy isn't doing well, or if the economy would be doing better. But everything that we've been hearing up until recently is that the economy is doing well. Not only just that the stock market's booming, therefore the economy is doing well. How about the payroll report? The payroll report came in, another huge one. And so for most people, their perspective of the economy is the payroll report and maybe the unemployment rate. But then wait a minute. The unemployment rate is moving up now 4%. At the same time, the payroll reports are stellar and huge. Now we have a big problem on settling what the economy is actually doing, because I think for the first time that I can remember, even mainstream sources, mainstream economists in the media are starting to question the payroll reports in a way we've never seen before. So now we have real questions about the economy and the situation where we are today, too.
Yeah, and it's for good reason, Jeff, because you look at the Fed regional surveys, the ISM PMIs, you look at even the Joel survey, which we know is more like the joke survey, but nevertheless, you start looking at all of this data and you come to the real conclusion is that there aren't all these hirings that the government is suggesting in the non-farm payroll report. It only makes you wonder why. Is that now a proxy of the equity market? That market goes up, well, the payrolls must be going up? Because the household survey, as we both know, is saying, look, the exact opposite is happening. Even the weekly unemployment claims. I mean, if indeed the non-farm payroll report was so robust, shouldn't we actually be seeing continued claims go down? But what did they spin this as? And I love this. The media said, well, it's because so many people are coming back into the labor market. Oh, so there's all these new entrants that are taking jobs away from the people who actually have some skills but are on unemployment? No, that doesn't make sense either. In fact, in my view, Jeff, and I'd love to get your opinion on this, I think people come back into the labor market because they don't want to. They're being forced into it. And you typically see this during periods of high inflation where maybe you have a household that's, say, 1.5 incomes becomes 2, or 1 income becomes 2, or 2.5, 2 incomes becomes 2.5. They have to go get more money and they show up on the participation rate. But that gets spun as, oh, well, look at all these people coming back in. And I'm like, no, something here isn't right. And well, we could look at the stock market, we can look at the non-farm payroll report, and it's very obvious.
Yeah, the participation or people coming back in the labor force, that's past tense because that stopped last fall, back around October. Suddenly the labor force participation rate started to decline again. In fact, the labor force itself is down about a couple 100,000 since then. So there was early part of last year and some parts of 2022 where people came into the labor force. And I agree with you, Steve, it was because they didn't really have a choice. But as they're trying to get more jobs and trying to get more incomes, the business sector said, we got none for you. We got nothing for you to do. We don't have a job available for you. So as we transitioned into this weaker period in, after October, the level of the labor force has actually stagnated. It's actually down a little bit, but stagnated. And if you actually use the same participation rate as we had last year, the unemployment rate wouldn't be 4%. It would actually be 4.4, if not 4.5%. Because unlike economists, we can't ignore people who would love a job, but have given up looking for one because they realize there aren't any. So again, it's another data point that goes way against the payroll reports, which suggests robust hiring when the fact that we have another participation problem developing on our hands that says that workers themselves have looked for jobs and they cannot find any jobs. So they've given up entirely. And if the unemployment rate gets up to 4.4%, if that's the real unemployment rate for this period of time, that's even more of a recession signal than before. Yes, the unemployment rate is low, but it's not the low unemployment rate. It's the direction. It's how far it's gone and how long it's going in that direction. So again, you're like, do I look for a job or do I buy GameStop shares and listen to Roaring Kitty?
Well, I think, Jeff, a lot of people are becoming traders because they're looking at the market thinking, I can't lose. And maybe I'll find the next GameStop and get rich. In fact, on Livestream, there are people posting like, hey, GameStop to 100. And there's absolutely no fundamental argument, even for trading at its price today. In fact, while we're filming this now, down about 40% today alone. Could you imagine? And so that's the challenge here is people are looking at the real economy. They're not getting ahead. The government's telling them, hey, look how great it is. And well, they don't see it. We don't see it. And yet, do you buy lottery tickets? Well, maybe you can't win with that. But the stock market, it just gives you this opportunity because, again, we're back at that phase. And you remember the bubbles, the peak of the dot-com bubble, the global financial crisis as we headed into that. There was this big view of you can't lose in U.S. equities. Well, eventually that day comes.
Yeah, it's the only thing working, right? And that's, I mean, literally in this case, because jobs are not happening. I mean, forget the payroll report. We know the payroll report is overstating the job market. I mean, there's the birth-death problem. There's the subjectivity of trend cycles. So, you know, even when mainstream economists are calling out the payroll reports for all of these faults, we're looking at the household survey, the unemployment rate's rising. There is no work. And so the only real thing that's working now is all of these casinos, the financial casinos. We've got a huge crypto boom cycle, they're calling it. Another crypto boom cycle, Bitcoin prices and everything else. You've not just GameStop, but just what is it? The magnificent seven shares on the NASDAQ. I mean, you cannot go wrong by, at least that's what they tell you. You can't go wrong by buying these specific stocks because they go up, and they go up because they go up. It becomes this circular reasoning that we, as you just said, Steve, that we see every time we get into these imbalances in these bubble situations where people rationalize price behavior as something that it actually isn't. But my argument here is that the stock market actually is a reflection of the economy, just inverse, just upside down in an inverse. The more people buy shares, it's because the less the economy is performing, the worse it's performing. So the higher share prices go, at least in the short run, I think the more we know that people are really struggling and looking for some sort of answer, some sort of way out of everything that they're stuck with.
Well, Jeff, that answer is obvious. It's the Fed. If they just would cut rates once, maybe twice, everything would completely change. And that's the biggest argument here. You have to be buying stocks because crazy because, Jeff, you don't get it. Fed just cuts rate and all of a sudden it's just going to unleash all the spending in the economy. And yes, if you're listening to this, I am completely joking here. In fact, Jeff's trying to control himself by not laughing hysterically on the floor. But that's kind of the notion here, is that the Fed is all powerful. And right now to this payroll report, look how strong the economy is. And now they're not going to cut right away. But boy, when they do, they're just going to unleash this pent up demand, because look at the stock market. It's telling you. No, we talk about things that happen in the economy, and the stock market's one of them. Why are people chasing stocks? Because there's nothing else. They look at, of course, they're looking at the bond market thinking, well, that's only going to get worse. They think rates have to go higher. They look at, should I go start a business? Well, no, that's just too expensive. In fact, we can look at the birth death model and probably assume it's a lot of day traders is what, of course, the BLS is factoring now. But you look at opportunities. If you're going to go out there and start to make money, where do you go? What can you do? And the answer right now for a lot of people is, well, it's the stock market, because every dip gets bought. So how can you lose? Well, until you do lose.
Yeah, that's the last rationalization, right? That the Fed is going to, the Fed put, right? That rate cuts or whatever the Fed actually does, nobody really knows, that they're going to make sure that the stock market stays supported. But as we've talked about this before, once the rate cuts start, it doesn't seem to help the stock market, because you think about the dot-com bust, for example. Everybody believed that there was a Greenspan put, but where was it? Where was it in 2001 and then 2002 and then the first half of 2000? Where was this Greenspan put? As rates went down and down and down, so did share prices. Same thing in 2007 into 2008. Where was the Bernanke put? Not only did he do rate cuts, he also had all sorts of other money printing liquidity operations. And yet, the more the Fed did, the more it got worse on the stock exchange. There isn't this Fed put, but as long as there's nothing forcing people to sell, the rationalizations can go on forever. And that's what we see. That's what we see Friday, when GameStop and Roaring Kitty was another exercise in rationalizing behavior that it just doesn't make any actual rational sense.
Jeff, it has everything to do with investor memory. They forgot about the dot-com bubble. They see it on the charts. They forgot about the bubble going, the global financial crisis. Everyone just has very short-term memory. They see, hey, that guy, who is he? He was a nobody, and now he's really rich. Well, you know what? I can be rich too, whether it's in crypto or whether it's in GameStop or some meme stock. It doesn't matter. My path to being rich is maybe one trade away.
Yeah, this time is always different, right? That's what we all tell ourselves. This time will be different. Well, this time is never different. Huge thanks to Steve Van Metre for stopping by and joining me today. If you missed our discussion last week on the state of the U.S. consumer, that's the video I've got linked below. As always, I thank you for joining me. Huge thank you, Eurodollar University members and Eurodollar University subscribers. And until next time, take care.